Hello and good morning to BMI's monthly webinar. My name is Cedric Chehab and I head up the Latin America research, the Americas research team here in New York. With me on this webinar is Richard Hamilton, head of Latin America research and country risk. He's joining us from London, and we will be both presenting the global risk to Latin American growth and our financial market strategy. I'm going to kick off with a few global views, and then Richard will take over for the Latin American section of the presentation. There'll be plenty of opportunity for question and answers after. We'll have 3 of them at the moment. In terms of our core global views, we believe global GDP will continue to grow in 2011 and 2012 by 3.2 and 3.6% respectively. And this is a slowdown from 4.2% in 2010, but a definite improvement from the contraction of about 1.9% in 2009. And underpinning this view is one of our core views that the U.S. is not in recession. However, we do note that additional weakness in some of the hard data, such as unemployment, manufacturing, or consumption, could change our minds. And we also highlight that domestic politics is key, especially in the run-up to the 2012 elections. We also believe that Greece will have an orderly default, but the Eurozone will manage to stick together. However, we note that fiscal unity will not happen until there's a large shock, which will push the leaders of Europe to take difficult decisions. Given this environment, we expect interest rates to remain near record lows in developing markets, and we expect rates to start to fall in emerging markets as these countries reach the top of their monetary policy cycle, and in the face of a global slowdown, for 2011 compared to 2010, these countries start loosening policy slightly. We also expect divergence will remain a global theme. So, for example, the Eurozone will be a region divided in terms of growth, credit spread, credit markets, and equity performance. The U.S. will face an uneven and weak recovery, with a few bumps along the way, and this is we expect consumers, for example, and small businesses to remain quite weak relative to blue chip companies who have been performing well. And similarly, from a global basis, we expect EM growth to act as a clear driver and will outperform developed states. So if we look at the next slide, what we note here is some tables with some data, and if you look at the 2 circles at the top on the top table, we notice that emerging markets are forecast to grow by 5.8% this year and 5.6% next year. And this is a real outperformance compared to developed states, which is just the line above it, where we see growth at 1.5% and 2.1% for this year and next. Similarly, if you can turn your attention to the lower table, for 2011, we notice that policy rates from 2011 to 2012 will likely decline for either decline for the BRIC countries or stay low by historical standards for some of the more developed states, such as the U.S. and Eurozone. Now, this growth for the global economy will largely be led by China and other emerging markets as the developed markets continue to deleverage. And the slow pace of growth in the U.S., Japan, and Eurozone leaves the global economy susceptible to several downside shocks or risks. In terms of risks, we actually note that one of the largest risks to the global economy comes from policy. There has not been a time in recent history which we can remember at BMI that policy has played such an important role. Of course, policy was very important in the financial crisis, but now what we note is that we risk falling back into double dip or into another kind of smaller financial crisis on the back of a lack of policy. So, for example, we believe that there are 2 elements to this. First one is uncertainty over policy direction, and this can reflect indecision over taxes or stimulus packages in the U.S., but also the potential for policy mistakes. And this is perhaps the potential for too much tightening from a fiscal front, which can really weaken consumers yet again. And similarly, in as well as a lot of fiscal austerity. And we're worried that one of the risks is that a potential disorderly Greek default. Another risk is that economic activity is slowing in developed states, and it's close to recession territory in some of them. This is as the consumer remains weak and unemployment stays high, and consumers and governments continue to deleverage. And we don't think it would take too much to tip us back into a recession, so that's definitely a risk, this low growth environment in the developed world. Similarly, the fiscal position of developed states has continued to deteriorate, forcing austerity measures. And this leaves very little room for policy action, particularly given that the Fed and the ECB are essentially pushing on a string right now in terms of monetary policy. We also note that the banking sector in Europe could deteriorate further, and this could further tighten financial market conditions, which would hurt both businesses and consumers alike by raising the cost of credit. And lastly, we also note that the potential for a faster than anticipated slowdown in Chinese growth, would have a negative impact on global demand. And we also note the risk of potential banking sector stress in China on the back of the potential for non-performing loans to rise in the face of a slowdown. However, it's not all bad news. Emerging markets account for about 40% of GDP, and growth is holding up quite well for now, despite interest rate hikes and financial market volatility. Driving this is strong domestic demand, general under-leverage by corporates and governments, as well as a relatively robust banking sector. Also, emerging market balance sheets are in much better shape than the developed world, and they have both monetary and fiscal tools at their disposal in order to stimulate demand if necessary. A third point is that commodity prices have come off the boil, and this will cool inflationary pressures. And this is important for at least three reasons. First, it will allow government stimulus. So if inflation falls, then there won't be so many concerns, and the government can either increase money supply or fiscal spending. And similarly, lower prices is actually good, as it will help. It'll contribute to consumer income, as the negative impact will be diminished, and it will also help profit margins for companies. From a more global level, what we notice is that blue chip companies, particularly in the developed markets, have posted record profits in recent quarters and are cash rich as they take advantage of strong growth in emerging markets. So blue chip companies are in pretty good position in terms of profitability and cash flow. In terms of search for yield, we think that globally there will be a lot of investments into the emerging markets as the business environment has continued to improve over the past decade, and we expect higher yield projects there will continue to attract investment. So, in conclusion, for some of our core global views, we expect growth to continue to grow in 2011 and 2010. This will be primarily driven by emerging markets. That said, there are significant policy risks and other risks, particularly from the European banking sector, as well as a slowdown in some of the major emerging markets. However, we do note that emerging markets will play an increasing role and a positive role. Now I'll just hand over to Richard Hamilton, who will discuss the Latin American focus of this presentation. Thank you very much.
Thank you, Cedric. So as Cedric said, global headwinds for the Latin American region are certainly building. But broadly speaking, we have and maintain a positive growth outlook over the medium term. We think headline growth will remain strong in the region, averaging 4.2% over the next 5 years. As we said, the region as a whole should perform well, although if you look at the table below here, we do believe that Latin America will lag other emerging market regions in terms of headline growth figures. This is not really surprising, given that GDP per capita in Latin America tends to be a lot higher than other regions, particularly Middle East, North Africa, and the APAC region. However, despite the fact we have a broadly positive growth outlook, there are going to be significant variations within the region in terms of growth. A lot of this will be driven by economic structure as well as specific policy decisions. So which economies are likely to outperform? Well, For a long time, we preferred economies that have a diverse export base, both in terms of geography and commodity basket, those that have strong domestic demand and are generally less correlated to U.S. growth. In terms of growth, therefore, we prefer the South American economies. In the Mercosur region, the ones we particularly like are Peru, Chile, Colombia, and Brazil. We also like Argentina from a growth perspective over the short term, although we believe policy risks there are elevated over the next few years. In terms of regions which we think will underperform, we are relatively pessimistic towards Central America and the Caribbean, particularly those Caribbean economies with significant debt burdens, and also Mexico, which we think will lag regional growth. These economies remain particularly vulnerable to a slowdown in the U.S. and elevated commodity prices. So how will a global slowdown impact the Latin American region? Well, we believe there are three main channels through which the global growth story will impact the region: trade flows, capital flows, and foreign direct investment. However, the pace and nature of the downturn will depend to a large degree on the policy responses of the countries involved. If we look at this next slide, you can see that in terms of exports as a percentage of GDP, there's vast divergence in the Latin America and Caribbean region. Those economies which have a larger export as a proportion of the overall GDP are obviously most exposed to a significant slowdown in trade flows. There has been significant diversification of exports away from the U.S. for the region over the past few years, particularly for the South American commodity-heavy commodity exporters, regional exporters. But because this time around we're concerned that China lacks the policy stimulus to ensure that growth remains very strong, we are concerned that these economies will also get hit hard if we do see a slowdown in global growth, and particularly in China. In terms of those economies most exposed, you can see from the table, it tends to be the Caribbean and Central American economies, whereas the likes of Brazil come out as relatively insulated from a global slowdown thanks to a very strong domestic demand base. Moving on to capital flows. Unsurprisingly, perhaps those economies with open financial and capital accounts are those which are most at risk. Since the start of August, we've seen a massive downturn in global equity markets, indicating what we believe is a massive investor concerns or risk aversion towards the region, in particular EM in general, but the region in particular. In terms of liabilities, we highlight Peru, Mexico, and Brazil as being the most at risk. If you look at the accompanying tables below, on the left-hand side, you can see international investment liabilities as a percentage of GDP. As you can see, Chile stands out as having the largest international investment liabilities as a proportion of GDP. But on the right-hand side, if we look at the net position, Chile is in a lot better shape thanks to its large overseas holdings. On the other hand, the likes of Peru, Brazil, Mexico, and Colombia, in net terms, look extremely exposed. Finally, looking at foreign direct investment. This is particularly important from a growth perspective in our view because of the region's relatively low savings rate, particularly compared to other emerging market and developed state peers. The main concern regarding FDI in our view is not that we'll see a rapid withdrawal of foreign capital or foreign fixed capital, but a drying up of future investment flows, which are crucial for those economies with low saving rates because it's where the majority of fixed capital investment comes from. Those most at risk, in our view, are those which have seen a large and increasing proportion of gross fixed capital formation as a percentage of GDP over the last few years. As the accompanying chart shows, in Central America, it appears to be Panama, which is most at risk from this, and in the Caribbean, Barbados is particularly at risk. So those are the three channels. Moving on to the policy responses. We've already seen policymakers start to respond to the threat of slowing growth. And given the sound macro management over the last decade, we still believe, despite the fact that we saw pretty ample fiscal and monetary stimulus in 2008-2009, policymakers have several tools at their disposal. On the fiscal front, we prefer those economies with better managed fiscal policies that are able to stimulate the economy in a sustainable and cheaper manner. Unsurprisingly, the front runner in this is Chile, given its strong fiscal dynamics. But we also believe Peru, Colombia, Mexico, and to a large extent Brazil are well placed to mitigate any downturn thanks to the potential to ramp up fiscal expenditure and increase debt levels. However, we are concerned about economies such as Argentina and Venezuela, which we think investors are demanding a higher premium for sovereign debt. they have more limited capacity to leverage up and boost fiscal stimulus, given the fact that the ample fiscal stimulus over the past couple of years. And we're also concerned about Caribbean economies, which face massive debt to GDP levels and will be unable to significantly boost government expenditure as they go through fiscal austerity packages enforced by the IMF programs. On the monetary policy front, the countries that have successfully improved inflation targeting credentials over the last decade or so are in a better place to provide monetary stimulus if growth does slow. On those fronts, we see again Chile, Colombia, Peru, and Mexico in a strong position to introduce further monetary stimulus. However, we are slightly concerned that Brazil's attempt to stimulate domestic demand by cutting rates 50 basis points in late August means that, particularly when inflation is still rising, could erode the credibility of the central bank and therefore the effectiveness of monetary policy, particularly if headline inflation continues to tick up throughout September and October, which first half figures for September seem to suggest they will. So that's the policy responses. There is one concern of ours as well, and that is if the slowdown, the global slowdown, proves more prolonged than we currently anticipate. Latin American macroeconomic management has come a long way over the last decade, and this is why that even with the fiscal stimulus in 2008-2009, we still see further room for several economies to pursue counter-fiscal measures in the face of another slowdown. That said, most governments have maintained a growth bias throughout 2010 and 2011. This means that fiscal stimulus has not been reined in to the extent that it could have been, and that sovereign balance sheets have deteriorated from the pre-2008 levels. While there is still room for further stimulus if growth slows, particularly on the monetary policy front, if it does prove prolonged, then we think that over the next 3 to 4 years, debt profiles could start to look concerningly similar to developed state peers. And as we mentioned before, in the case of Brazil, we believe that central banks could erode credibility if they prove too accommodative without signs of slower inflation. So how does all of this translate into our financial market strategy? Well, for the time being, unsurprisingly, we maintain and continue to maintain a neutral to bearish outlook for the time being. As Cedric said before, our core view is that we will see an orderly default or an orderly restructuring of Greek debt, and this will mean that whilst the global growth will slow, we don't anticipate another global financial crisis in the mode of 2008-2009. However, we should note that there are significant risks that a restructuring or a default will be disorderly in the Eurozone, and this could lead to significant global growth and credit headwinds. Either way, we need to see resolution of the Greek debt problem before removing our neutral to bearish market strategy view. That said, if we do see some kind of resolution to the Greek problem, over the medium term, we believe that monetary easing in the Latin American region will reduce the demand for the carry trade. This implies that relative performance will be driven more by growth and balance of payments dynamics than high carry. Our topics based on these measures are the Brazilian real and some of the other South American currencies such as the Peruvian sol. Our least favorite because of the high proportion of short-term money market capital or capital into Mexico's money markets is the Mexican peso, because the performance of the peso has been driven primarily over the last few quarters by demand for the carry trade. Moving on to equities. Over the medium term, beyond the current financial market volatility, we like equities which are exposed to strong domestic growth stories, those which have accommodative monetary policy and where valuations are looking cheap on a relative and historic basis. Our topics on this metric would be Brazil's Bovespa, where trading price to earnings are very cheap, not just on a relative basis compared to other bourses in the region, but also on an historical basis. However, again, we reiterate that this is a medium to long-term play. For the time being, we remain very cautious to bearish towards all equities in the region. And finally, fixed income. In the short term, the last couple of months, we have been bullish towards local sovereign debt markets as we anticipated an end to the rate hiking cycle. However, yields on local debt have come in a long way since the start of August, and we think there is limited capacity for yields to come in aggressively over the near term. In fact, over the last couple of weeks, or the last even more recent trading, we've seen yields head significantly higher, primarily off the back of currency concerns and a sell-off against the dollar for most of our regional FX majors. If this continues, and if yields continue heading higher both on local and external debt over the next few months, we think at some point they will start to look attractive. But again, for the time being, will remain neutral to bearish. Our top pick, therefore, would be bearish Venezuelan debt, primarily due to our concerns not only over global risk aversion, but also we see a slumping global demand leading to lower oil prices, and we are very concerned about Venezuela, the government's cash position, and the overvalued currency. Our key conclusions, therefore. Firstly, we believe the global recovery will continue through 2011-2012, led primarily by EM growth. In our view, the Eurozone poses the largest risk, although there are others, primarily in the form of policy mistakes. Latin America, in our view, will perform well, but there are significant divergences within that strong performance. The Southern Cone economies will outperform, whereas the Caribbean, Central America, and Mexican economies are likely to underperform. The region is also likely to face significant policy constraints, as well as longer-term policy risks if global growth proves prolonged. And from an asset class strategy perspective, we remain neutral towards regional FX and equities until we see a resolution of the Eurozone crisis.
Thank you very much, Richard. Now we can go on to the next section, which is the Q&A. Erica?
Okay. First question. What is your view on China, and how will it impact the countries within Latin America?
I can take that one. So just for some of the people listening who are less familiar with our view on China, we're actually, as a research house, slightly less bullish with regard to the Chinese growth story, and we highlight a few risks. And this is largely because of the economic structure of the Chinese economy, and as well as the policy response to the global recession of 2008-2009. So during the recession, China actually unleashed some unprecedented monetary and fiscal expansion overnight. For example, it took China only 2 years to add the same amount of new money, which was about 2 trillion yuan, that it had been created in the 6 years previously. So what we saw was a huge fiscal stimulus combined with a massive monetary stimulus at the same time. And this increase in liquidity fueled both a housing boom as well as further local government investment in infrastructure projects, which had little or no marginal return on investment. And what we're seeing now is that the property sector is now displaying signs of a bubble, with, for example, falling prices as well as falling number of transactions. And similarly, some of these projects, infrastructure projects, have zero cash flow, and they will result, and are resulting in some cases, in non-performing loans. And this will have a severe impact on China's banking sector, which will further impair the Chinese growth story in our view. At the same time, we know that U.S. and European demand is faltering. And so combined together, we are not outright bearish China by any means. But what we are is very careful about, we're cautious about the risk in terms of non-performing loans and how that could impact the banking sector in China. And we don't think that these risks should be underestimated. Now, the impact on Latin America depends on whether China has a soft or a hard landing, and at present it's a little bit difficult to gauge. For now, we kind of have the idea that China's going to have a hard, soft landing, if that means anything. But how it'll affect Latin America on a broad level is primarily through 3 channels. And as Richard mentioned, Latin America as a region is known as a commodity exporter, and China has provided a lot of the demand for these commodity exports. So through one channel is through demand for these commodities. The second channel is actually through it's similar, and it affects the price of these commodities. So not only does it affect the volume of exports, but also the value of exports for these commodity exporters. And the third channel, which we highlight, is through infrastructure, investments into several sectors of the economy, such as road and resource sectors, transport and resource sectors. China has been driving a lot of this investment in infrastructure, both in the resource and transportation sectors in Latin America and the Caribbean. And not only has it invested itself or provided cheap loans for financing, but its demand for these goods has stimulated other companies locally to invest in those sectors as well. So it's kind of like a double impact in that sense. So depending on whether China has a slow or hard or soft landing, will determine the magnitude and the effect on Latin American growth. However, as a whole, it'll have a direct impact on Latin America. Richard, do you have anything to add?
Not really, Cedric, just broadly in line with what you've been saying. We still believe that over the long term, China will be a key player in Latin America's economic future. And we've seen that increasingly. So even though we are anticipating maybe a slowdown in certainly trade demand, potentially capital inflows into the region as well from China, over the long term, Latin America's economic future is certainly, China plays a massive part in that.
Thanks, guys. Next question is, who do we expect to win Argentina's presidential election, and what does this mean for policy continuity there?
Well, second-guessing any election outcome, particularly in Latin America, is a dangerous game. So any time we do that, we do it with a note of caution. However, looking at recent polls, it appears that the presidential incumbent, Fernandez, is highly likely to win the upcoming election. That said, there's a huge amount of uncertainty over the shape and trajectory of policy beyond the election. We've been cautious towards Argentina's economic and investment outlook for a long time now. We've had a lot of clients who operate in the region and in the country who have suffered at the hands of the often business or non-business friendly economic policy mix, particularly the concerns over inflation, and that the official reporting of inflation appears to be underreporting the extent of consumer price pressures in the economy. So this has been a major concern of ours, and until we see some kind of attempt to really address the issue of inflation reporting in the economy, we remain highly cautious. What will Fernandez do if she does win, and how will economic policy likely look like under a second administration of Fernandez? In our view, we have not seen enough from the present government to suggest there will be any substantial change in policy formulation or policy trajectory. For that reason, we remain highly cautious. There is an outside chance in our view that if the government does win a resounding victory, it will have the strength to drive through the necessary reforms. And by necessary, we will need to see a significant pullback in fiscal expenditure, a significant attempt to address the underlying causes of very high inflation, and a return to the international capital markets. But for the time being, we believe that's there's only an outside chance that we'll see all these issues addressed, so we remain cautious towards Argentina's economic future.
Thanks, Richard. Final question for today, asking if we can expand on our view on Mexico a little bit, about why we have a negative outlook on Mexico.
Sure, I'm happy to take that one on. We could talk about the outlook for Mexico for a couple of hours, but obviously I'll try and keep it brief. Our view on Mexico is not that we are negative as such, but on a relative basis, we think it will underperform regional growth rates. Why is that? Well, our main concern with Mexico is that while the economy has diversified away from its dependence on the U.S., back at the start of the previous decade, exports to the U.S. were around about 90% of total exports. This is now down to about 80% as of the end of 2010. This is an improvement, but it's not enough. Mexico is still hugely dependent on demand for durable goods from the U.S., and the best indicator for this is the correlation between intermediate goods imports, the year-on-year growth rate of intermediate goods imports, and domestic economic activity. The correlation is close to about 90%, and it's actually increased over the past 3 to 4 years. Now, intermediate goods imports is a proxy for Mexico's re-export, or traditionally was known as the maquila sector. And it is this that really drives the Mexican economy. Since 80% of Mexican exports still go to the U.S., that means that a huge amount of the economy is still driven by demand for U.S. demand for goods from Mexico's manufacturing sector. Throughout 2010 and in the first half of 2011, we have as yet not seen any clear signs of this strong export picture, and I should note here that the manufacturing performance has been very strong over the last 18 months or so, stronger actually than we had initially anticipated, and exports have hit record highs. But this has not translated into a strong domestic demand play from Mexico. We haven't seen a strong pickup in private sector credit, or particularly household credit. And whilst retail sales and confidence indicators were improving at the start of this year, we have since seen them tick down slightly, which is concerning as it obviously is in line with what is happening in the outlook for global and particularly U.S. growth. In the future, there is certainly potential for Mexico to turn this around. One way would be to refocus or try and significantly boost exports to South America, and there are some hopes that this could have an impact. Brazil currently receives just about 1% of Mexico's total exports, but recently free trade agreements, particularly with regard to the auto sector with the Mercosur region, could see this increase significantly over the next few months and years. But our concern is that we have not seen ample evidence to show that the Mexican consumer is ready to start spending. And as we're heading into another global, what we anticipate will be a global growth slowdown, then this is, we haven't seen enough to change our view that Mexico, from a growth perspective, will remain a regional underperformer.
Thanks, Richard. Thank you, Cedric. Thanks to both of you. So that wraps it up for this month's monthly presentation. We'll hope you'll join us next month for our presentation. And thanks for participating today.
Thank you.